Signals of red-hot inflation rattled investors once again. Is the fear justified? Hi, I'm Griffin of Derivative Logic, here to get you straight to smart. The Consumer Price Index, or CPI, the Fed's favorite inflation gauge, continued its rapid surge in June, rising at its fastest pace in nearly 13 years. The CPI increased 5.4% from a year ago, the largest jump since just before 2008's great financial crisis. If you remove the volatile food and energy components to it, core CPI rose 4.5%, the sharpest move for that measure since September of 1991. What's it all mean? Sure, the inflation headlines are scary once again, no doubt, but if you dig deeper, beyond the media headlines, you'll see that the data doesn't imply that higher prices on most goods and services that we all use routinely will ever show up, let alone persist. Here's why. June's CPI report shows, for the third straight month, that most of the price pressures are in reopening sensitive areas of the economy, like used cars, rental cars, insurance, lodging, airfares, and dining out. For some perspective, used car prices alone accounted for 20% of the year-over-year change in the CPI. Despite the spooky inflation news headlines, the makeup of the price increases means that the Fed can still subscribe to its transitory inflation belief and take its time in easing off the stimulus gas pedal. As we've been saying for literally weeks now, expect inflation in these categories to run hot all summer as households flush with extra savings are eager to spend it after lockdowns amid extreme supply shortages. For interest rates, it means that you can expect long-term rates to stay well within their current ranges, likely into the fall. As we move toward the third quarter, though, enhanced unemployment benefits will dwindle and new jobs and higher wages will lag, tarnishing the consumer's conditions for wanting to buy shiny new things somewhat and quenching red-hot demand as their discretionary income gets squeezed. It's a scenario that will show up in the form of lower economic growth than was previously expected just a couple of months ago. The dynamic only reinforces the Fed's easy money, low interest rate, transitory inflation theme as the correct one. For the week ahead, it's a skinny data and event calendar which is filled with gauges on the housing market, including builder optimism, housing starts, and existing home sales. From all of us at Derivative Logic, have a great week.